Hello and welcome to the Property Investors Podcast. My name is Tom Webster.
And I'm your co-host, Rob Holmes.
And we have just finished a fantastic episode with Nicole Bremner. So Nicole, I've been following her on LinkedIn and seeing her story, and she's really active on all the socials and sharing what she's about. So I thought we'd get her on the show and just get a bit of a deep dive in her as an individual and sort of the investment journey that she's gone on. But with me and Rob, just obviously when we finished the call, we was just saying how just fancy. She's so lovely. She's just such a nice, really interesting podcast. Someone so knowledgeable, isn't she? She just knows exactly.
Yeah, she's done really well. She's gone from kind of buying properties in Hackney and flipping those, but she goes into why she bought to flip and build capital rather than, buy, refurb, refinance and hold. She talks
and doing the reverse of a lot of people are buying these old family homes and converting them into HMOs, and she's buying old HMOs and converting them back into family homes. And it's really good to see sort of the flip. And the other thing I thought was interesting as well is obviously when we talk about investment journeys, you tend to talk to people that start off with 100 grand properties, or they start off really, really small and work their way up. But Nicole's got a bit of a different journey where she was in she stockbroker, investment banking, but she was working on Wall Street for Goldman Sachs. So she was a step ahead of maybe some people starting their journeys. But like I say in the podcast, is you can only work with the cards you're dealt. So she was dealt with a hand when she entered property a bit stronger, but obviously had to think bigger and do bigger. So did big projects and high values. We talk about millions and 2 millions rather than 100,000, which is interesting because it's a completely different story. But she doesn't come from money, which I think is also really interesting. So she was saying that her parents were nurses and her grandparents had a farm, and she's from Australia, and it was all very much, you worked really, really hard for every penny that you earned. And then she went and created a life for herself that is far, far beyond working in a farm. But no, really, I really enjoyed that one. Just a couple of plugs from us. So please do subscribe to the show. So if you're listening to us on Spotify or Apple Music, please make sure you subscribe. If you're on YouTube, make sure you subscribe. And then at the same time, we're on all the socials at Podcast Property, and the website is podcastproperty.co.uk. And if you want to get in touch with me and Rob, it's very easy. It's Tom at podcastproperty.co.uk or Rob at podcastproperty.co.uk. Anything you want me to add, Rob, before we get the show started?
No, all good. Let's go.
Enjoy. Good morning, Nicole.
Good morning. How are you guys today?
Yeah, really well, thank you. How are you?
Yeah, good, thank you.
Good. So you were just saying that you've got 4 kids off school.
Yes, I do. Yeah, COVID shut their school early. So online school, their school's doing a great job though. So they're up there. One of them's got PE. So something that's PE.
A bit of Joe Wicks upstairs.
So where are you based then?
I'm in Kent. I'm in Rochester. So I moved down here in October last year. For schools, I was facing this situation where I've got 3 children of my own, and I was facing this situation where my partner and I were going to have 4 children at 4 different schools, and we just thought, this is utterly ridiculous. How on earth am I going to do the school run and coordinate all these various things? So we started looking at a school where all 3 of them could go right through to the end. So we found that here at King's School in Rochester, which is incredible. So yeah, moved down for the school.
Oh, fantastic. Well, you're not too far from us because we're Sussex. So we're sort of near, we're near Brighton way or closer to Eastbourne. So yeah, not too far. The way we like to start the show is we like our guests to introduce themselves, explain sort of your history, where you've come from, who you are, what you're doing. So sort of a bit of like a preach for a moment. So let us know who you are.
So I was born on a farm. Right, well, I could go back that far, but I should be lying down on the psychologist's couch. But anyway, so I'm Australian, as you can hear. So I came over here in 2000. I'd been seeing this guy for a couple of months, and he was transferred to London and said, "Hey, do you want to come?" And I went, "Yeah, get out of Australia, woohoo!" And travel. So we moved to London together, and then we did a few years in London. I was working in banking, and then he was transferred to New York, and so we then went over to New York together. I had a baby. That was a big life event. Had a baby, had our first son, And then I started back at work at Goldman Sachs on Wall Street. And that had always been a big dream of mine, just to actually work on Wall Street. But the first day I started there was the day that Lehman Brothers collapsed in 2008.
No way.
The day.
Yeah, the day.
Wow.
So I sat there in this big room full of other analysts, just with all the TV screens around, just watching people just exiting Lehman Brothers with security in boxes and things. And I just thought, I'm on probation. It's not going to be extended. My contract is not going to be extended. And sure enough, it wasn't. But then I found out I was pregnant again with baby 2. So at that time, my partner just said, look, let's move back to London. I think it's a better place to raise a child, although I love New York. But anyway, so moved back to London and then had my second child. And that was when I walked past this house, this derelict vicarage, and just went, I really need to own that place. And it had a handwritten for sale sign on it with a phone number. By the time I'd walked back, it had a Foxton's for sale sign. So anyway, I rang Foxton's, got them in there by midday that day. By that afternoon, it was a Friday. So by that afternoon, we'd put in our offer and it had been accepted.
What was the offer?
What was the offer?
Yeah.
Lots. It was an 8-bedroom former vicarage in Hackney. But this was great because it was in 2009, just before property prices went crazy in Hackney. It was just at the uptick. So we were really fortunate to get this house. I then spent the next 18 months renovating it and having our third baby. And I just loved the experience. But and that's when the whole idea of property came to me, because I'd done a flat before. And I should mention that I think property, a lot of it is luck, actually. I think that a lot of people believe they've been skillful, but actually they've just been really lucky. And another example of that is a flat. So we bought this flat in Clerkenwell in 2004, I think, 2002, 2004. Bought it for 423,000. Lived in that until we went to New York. Went to New York for 2 years, came back, and the flat had doubled. Yeah. And by the time we came back, and we sold it for 880 or something. I can't remember the exact numbers. And we just thought, wow, this property thing, it's amazing. And I'd bought another flat in Austria, a ski chalet, and renovated that. Loved the process. And that's when we thought, okay, there's something in this property. And I just honestly got really lucky because I invested in Hackney at a time when Hackney was the best performing borough for a few years in a row, I believe. The price growth over 20 years was 960%. And so I just got really, really lucky and was able to ride that wave. No skill on my behalf, unfortunately, although I did create some really beautiful homes. So yeah, that's sort of my first step into property. And that was in around 2010 through to 12 that all of that happened.
Fantastic. Cool. So you say you got lucky on the way in. So from the sounds of it, no one really pointed out to you how good property was. No one kind of trained you or mentored you. You didn't kind of see anyone else doing well out of it. You kind of just fell into it just by kind of bumbling along the street and seeing a house that you wanted and doing something really, really nice to it, right?
Absolutely. I didn't have a mentor. I didn't know what property education was. I didn't even know that people like myself could be property developers. I thought that was the Berkeley Homes, and I did not think that people like me, I didn't even know what development finance was. So I didn't realize I could get a mortgage or a development loan. So I was renovating houses in London, in Hackney for cash, because I didn't realize that there was all this finance out there. So I was putting down, and I've always been very honest about that. So we made 800,000 from that flat. So I was able to put that 800 plus another 200,000 and use that for my first. And I always am very open. Not everyone starts with £1 million cash. I did. And so that allowed me to scale much quicker than someone who had, say, 100,000 or 10,000. So I was very fortunate in that way. But still, you imagine if I'd leveraged that, what I could have done in that time. It could have been really messy.
I'm a really firm believer that you played the cards you're dealt. Some people are dealt a tougher hand and some people are dealt an easier hand, but you still have to make something of your hand. You can't, it doesn't just fall on your lap. You still have to do all the work. Yeah, it's a bit of an advantage and a bit of a head start, but you've then got a bigger dream and you're still fighting a harder fight than the lower stuff. So yeah, so
yeah, no, exactly. And just on that, I think it's important to point out that I wasn't born with a silver spoon in my mouth. My parents were both nurses with 4 children, and money was really tough. And I remember so distinctly one Christmas when I was around 9 years old, and for Christmas I got an oil burner. And that was it. And it would have cost maybe $30 at the time. And that was all my parents could afford. And this was at a time when interest rates were 17, 18%. They peaked at 18%. And things were really, really tough for my parents. And I didn't have much money. I paid my way through university. I worked 2 jobs. I got fired from one from sleeping through my alarm and not turning up, but I was shattered. So yeah, it was tough. It was really, really tough. But I think that some people will relate to this. Some people just have this burning desire inside of them just to get ahead and make money. And I'm sure people will relate to that. I just had this deep yearning to make money.
I think we all 3 of us have got that one.
Yeah.
So if we go on, go on,
Tom. No,
I was going to say, if we go back, if we go back to sort of childhood and education and stuff. So do you think that seeing your parents, I'm not going to use the word poor, but your parents working really, really hard, do you think that's the thing that installed it in you, or do you think it's something that you earned yourself, or how do you feel that you got that far in your belly?
Yeah, definitely my parents and my grandparents as well. My grandparents were farmers with 5 children. They always ran a dairy farm. They would go on one holiday a week, a year, if they were lucky. Holiday a week. Yeah. All right. That's my life. Or was. So they would just be really hard workers. They're up at 4:30 in the morning to milk the cows, and if you're sick, cows have to be milked. You cannot just not milk the cows. So they really worked hard. And so my mum from a very young age had she'd looked after her siblings, and every sibling had a responsibility, and hers was cooking. And so she would cook for the family while my grandmother milked the cows with my grandfather and ran the farm. So, and then my father as well, the way they met is he was 16 and he was a bit of a naughty boy in New Zealand, and he was sent to Australia to work on a farm to sort of straighten him out a bit. And they worked really, really hard. And I always saw them just working at least 2 jobs. They always had their nursing, so they'd do night shift, and then they set up their own businesses, and they always built their own houses as well, or did extensions to them. My father still does. He does his own homes in Australia. He just finished a lovely project recently in Queensland. So I always grew up with that. And I didn't realize what an impact that had on me until later on. And I think that, that definitely was from my parents.
Go on, Rob, you had a question.
So after those first few houses, so the flat, the vicarage, you're now kind of eyes open to what can be done with property. And it sounded actually, yes, there was the money there that you made, but you really enjoyed the process of renovating the property and actually turning it into something that you'd created. So let's go a bit deeper into that. What is it exactly that you like about the property? What is it that you were doing? What's your style? What is it that kind of gives you the passion for doing it?
Yeah, I read a really interesting book yesterday. I actually got it right here. Called, oh, there you go. Probably backwards. What I Learned Losing $1 Million. And
I thought you was going to get your book out then.
I've got my book over there. I'll do that next. But it was really, really interesting, because they said people invest for 2 reasons, either for money or for recognition. And I really pondered on that and thought about it. And this is a very long-winded answer, Rob, but
okay.
I think that part of it, yes, I loved the money and it was great to make the money, but I really loved the recognition, because having left banking in 2005, really, because then we went to New York and things, I really craved that recognition that you get from a corporate job. You get your twice a year performance review, you get bonuses, you get this recognition. And I found that being a mother, or being a parent full stop, often you internalize your child's achievements as your own. So for me, the child would walk at 12 months and I'd go, yay, I'm a great mom. And that was what I had. And I'm not trying to belittle anyone who is a full-time stay-at-home parent, but for me, it wasn't enough. I needed more than that. I needed more recognition and personal recognition for what I was doing. And so for me, it was a case of doing these because I was really proud of the job that I'd done in creating these beautiful family homes that I love. And last week, Inside Property Investing did a 7 days of property, and it was really good to participate in that and just look back at the properties I did and just think, wow, I really loved them and I was really proud of them. And I think that's what I did, and that's why I did it.
Cool.
So what is your investment strategy? So what are you looking for when you're investing in yourself, and how do you pick your properties, and what are you doing with them?
Yes, so another really interesting statistic is 90% of investments were trades that went wrong. So, and I think that's true in maybe stock market terms. But just to give some context to that, my strategy was always buy, renovate, sell. Always. I didn't need income. All I wanted to do was sell them and turn over the capital and keep the capital growing. So that was my strategy. That has all changed recently. And I think in 2017 was the last time I bought a property. And that was one on Hackney Road. And things have just changed. And I think that because the market's changed, you don't have this rapid growth within the buy and sell type market. Margins were squeezed, and they were squeezed because of the Section 24, is it, the landlord tax changes, because of stamp duty changes, and also because of Brexit. That really took the air out of the market and the market deflated. So because of those things, it no longer was viable to do what I was doing. So I had to change strategy. Also, I'll be very, very honest, there's some issues within the portfolio right now where we're not going to make any money back on some of the projects. And there's nothing like the risk of losing capital to change your strategy. So now I'm looking to hold some of the projects that I've got that were supposed to be sold. And we're talking about 100 units. So it's not insignificant, but there are about 100 units within the portfolio that I own a share of. So looking to hold some of those. But as far as what I'm looking for going forward, and I'll come back to what I was looking for too, because I think that's quite interesting. But what I'm looking for going forward is some things that are a bit more passive, because my goals have shifted as well. I'm older now. I'm 43 next year, I think. Yeah. And so my children are getting a bit older and less dependent on me. And I want to spend a lot more time doing things I love, like sailing and just traveling and being free. And I think that's something that when you're this driven, you tend to front load your life and you do everything really, really quickly. And you kind of lose that early part of your life. You might not go off backpacking or traveling. So for me, I now want time, and I need to have a look at what investment strategies will bring me that time. So for me, it's about perhaps buying the ends of developments that developers might not have sold. So if they're doing a 100-unit scheme and they've still got 10 left that they can't sell, buying those at a discount and then just putting them with a manager and receiving rent checks every quarter or so. So that's definitely what my strategy is going forward. And just being really happy with sort of a 6% return would be nice. That's it. What I was looking for, which is much more exciting, is a luxury. So I was buying, and I didn't even know that there was a term for it. I was buying what I thought were bed sits, but really they were HMOs, and I was converting them into luxury family homes. And this was a wonderful strategy. I loved it. It was creating something that was so beautiful out of something that usually was really ugly. So, and that I had a rule of thumb, and this is interesting. If the market starts overheating or growing again, I think this is a really good rule of thumb for people. If I bought for $1 million and could sell for $2 million, that was the perfect property for me, because that would allow me to make my margins. Buying for $1 million plus all your costs, then your renovation, there was about a £500,000 profit in that. And that for me is a really good rule of thumb. If you can buy something for 100 and sell for 200, you should be able to get that. It should be a sort of 50% of your costs should be the construction costs. When I interviewed Tony Pidgley, the former chair of Berkeley Homes, who recently passed away, he uses the rule of thirds: a third for acquisition, third for construction, and a third for margin. And I think that again is a really good rule of thumb when looking at those sorts of development projects.
Cool. So I picked up on something there, and there's a few things actually that I want to kind of cycle back to for the people listening and watching. One of them was actually really, really interesting, and it's the first time I've heard, and I think probably the first time Tom's come across anyone that's done this as well. You're actually doing the opposite of what most people in property are doing. So most people in property that I've spoken to, seen on Facebook, seen on Instagram, network meetings, it's all about taking the family home and turning it into an HMO to make the cash flow, because you'll get one set of rent for a family home, but if you rent it out as a 5-6 bed HMO, the cash flow, the net monthly profit will be higher. And you're doing completely the opposite. So you're taking those HMOs and turning them back to family homes. So what got you into that? Because what got you into that? Where did you spot that opportunity? And are you kind of one of very few people doing it? Because I think you probably are.
Yeah, I definitely was at the time. And this is something that I've been asked numerous times. People are saying, what? Why did you do that? Now, there are a couple of things there. First of all, if you've got an area like Hackney and Islington where there's a huge amount of house price growth and froth in the market, and I think we're going to see this again in the coming years, because property is cyclical. It's like any investment. Unfortunately, we are herds, we are crowds, and crowds have emotions, and emotions are the same no matter who we are, and we follow these cycles. So we are going to have an uptick in the coming years. I just don't know when. And when that happens, certain areas of London or anywhere in the UK, anywhere, any city, anywhere really, is going to experience growth if proportionately they are undervalued compared to their neighbouring areas. Let's take Luton, for example. And there's a lovely place out near Luton, which the name escapes me. Anyway, you've got this really expensive, affluent area right next door to Luton. And it just makes sense that the next upturn, Luton, is going to grow as well, because it's right next door to this really lovely place that is very overpriced. Well, fully priced, let's say. So that's where you are able to find these HMOs. And it's just maths, because you work out what your cash flow would be, and you discount that back to present value. And probably this is the banking analyst coming back in me. But you discount that back to the present value of that cash flow, and you realize, actually, this makes more sense to sell as a family home right now. So that's the first thing, is that when property prices are rising, often you'll find that it's a better investment to do that as a family home than as an HMO.
And just sorry, let me hold you there for a sec before you move on. So can you just go a bit deeper into what you mean for the listeners about working out the cash flow and how that, I know what you're talking about, but what we like to do is we like to break it down even further for the listeners. So sure. Where you talk about what you're going to make as cash flow on an HMO, are you talking about you're going to make X amount per month times 12 months times 10 years, and I'm going to make X amount, but actually if I just sold it, I'd make more than that in 6 months?
Exactly.
So can you break that down a bit more?
Yeah, sure. So let's go back to my rule of doubling. So if you buy an HMO for $1 million and you believe, and that's backed up by evidence, that you can get 2 million, and you believe you can get your costs within 500, you know that you will get you expect that you'll get 500,000 for that. So what do you need to get in cash flow terms over the next few years in order to make that same 500 back? And is it worth it? And that is about discounting back that cash flow. And just you can Google that. I won't go into the maths now, but if you just Google discounted cash flow models to get the present value, you'll be able to work that back. Or just a very simple rule of thumb. If you're going to get, say, what would you expect for a £2 million property? You'd probably expect, what, 5,000 a month? Just off the top of my head. I don't know. Don't quote me on that. But let's just say that 5,000 a month. That's a lot, and that's gross. So that's a lot of months to get your 500,000 net. So you've got to work out whether you really want to stick at it for the X number of years that it's going to take to get that 500, or whether you take the 500 now.
And deal with the tenants and the licensing and.
Absolutely. And that's my next point, is that I believe, and I'm happy for people to prove me wrong, but I believe that most people out there who are investing in HMOs are hardly making minimum wage. And if they were honest with themselves and looked at the wage they pay themselves, the time that they invest, the admin heavy nature of HMOs, I think they would find that they're not earning minimum wage. And I'm happy to be proved wrong. And I know I'm good friends with some people who have them and swear to me that they're doing really, really well. But they're really hard work. And I don't want that hard work. And so for me, I need to incorporate that cost of my time into that. And let's just say I think I'm worth, I don't know, £500 a day. I've got to factor that in and see what my real return on that HMO is. And I just, I'm not buying into all the hype on HMOs.
I get the feeling that you enjoy the design aspect as well. And I think there's something architecturally beautiful about taking something that is a bedsit style. And especially, you can imagine in your mind's eye some of these properties in London that have been run down and been used as bedsits and where they go, to then turn that into a beautiful family home that can be used. And a lot of these buildings are beautiful buildings, old Victorian, old Georgian buildings that have been used as bedsits, but to turn them back to their thing. I kind of get that sense that's probably where you're coming from as well.
Absolutely. And that's not to say that can't be done. And you look at Mike and Victoria Stenhouse, you look at B-Space Properties, Tom and Philippa Cherrier of Fat Properties, Brad Patney, all these people are doing really beautiful HMOs that are very design-led. And so it does happen. Phil and Tom do student accommodation, but it's all very, very beautiful. So this does happen. It's just, for me, I don't want my whole life to be property. I have children. I've got a lovely partner who's got a boat that I love sailing on. My time is now more valuable than sitting behind a computer screen day in, day out, worrying about tenants and licensing and gas safety certificates and things. I want an easier life.
So do you invest in other people as well as yourself? Is it, because you mentioned 100 units there, so I'd imagine that's quite a big project for an individual. So are you working in a consortium? Are you working with property investors, etc., etc.?
Yeah, we were one of the forerunners, I guess, or the front runners of crowdfunding, property crowdfunding. So I've got around 170 investors across 6 crowdfunded projects, and then I've got another three projects where I've got private investors, just one or two. One of them's got 3 investors in that. So the one in Luton, we've got 2 other investors or investment groups in that. And that's one that we're just completing this year. Finally.
And what is that? What is that project? What are you doing?
That we bought that as 40 units, 40 residential units, 1 and 2 beds with a commercial. And then we got planning for 47 residential by putting an additional floor on. And then we went back to planning just recently and got rid of the commercial, which is great in this environment. So now we've got 49 flats with parking, and it's right by Luton Station. So
in addition to the 45 that were already there?
No, sorry, 49 in total.
Okay.
So we were able to convert the commercial on the ground floor because it was not very valuable and no one wanted it.
Fair enough. And I picked up on, you said that there's some issues in the portfolio, which is kind of what's forced a mindset shift and a change in in kind of priorities and what you want out of your portfolio. So if you don't mind me asking, what are those issues you're facing and why do you think they've come up?
And also,
finally,
can I
how are you dealing with
can I tag onto that as well, and sort of like the lessons that you've learned from those issues as well?
Yeah, absolutely. So I'll try and give you a really complete answer there. So I think obviously there's a lot of things in place. So I can't say too much about things because there are confidentiality clauses within shareholders agreements and things. But what I will say is that we were probably over enthusiastic about buying in the run up of property, sort of 2015, 16, 17. Things were really, really going well. And I think the construction partner took on far too many properties and was unable to then complete them out. He was just not used to dealing. He didn't have the systems in place to deal with as many properties as that, and so shortcuts were made. And then it was then left to me to try and resolve how we're going to deal with these projects that have been delivered not as you would expect them to be delivered. So that's taken just a huge amount of my time over the last 2 years, which is probably why I value time now, because it has just been exhausting over the last 2 years, just dealing with 170 investors and with at one point, I think we had about 110 units. We have sold some down now. So there's just over 100, I think. And just dealing with all of those. And because there were time overruns, we had refinancings to deal with. And then we have, of course, the air coming out of the property market, which is meant that when we had a lovely 50% loan to value across or 40 to 50% loan to value across the portfolio, we're now coming up and hitting some of the 60 to 75 loan to value maximum. So that's been incredibly stressful, just dealing with all of that. So that's sort of all I can say about the issues. But what I can tell you about the lessons learned, and I think that I think these are really important lessons for anyone. First of all is don't take on too much. The property or anything you do, any endeavor is supposed to be for the long term. So treat it as such. It's not a sprint. It's not about who has the most properties or who's made the most money. It's about surviving. And the number of property developers who fall by the wayside, we're going to see even more of it. It's going to be ugly. So just be really prudent. And I think that's the best word to use. Be very, very prudent. Be very, very cautious. Treat your best case as a unicorn scenario when you're analyzing. Treat your worst case as your best case. And that will always then provide you with a prudent valuation for anything that you go into. That's the first thing. Secondly, is be very careful about working with investors, because yes, it gives you additional funds to, it gives you additional funds, but it also gives you additional responsibility. Working with people's money is very, very difficult. And you need to ensure that you've got really good systems and processes in place in order to deal with that, because they have their own expectations, rightly so, of communication, of returns, of access to the developer, and you've just got to be really aware of that. Sorry.
Cool. So I've got a question going on from that then. Talking about you personally now, because with this bigger stuff, you've kind of touched on the fact that there's other people involved, and sometimes you have to clean up other people's mess, fix things that people don't handle, etc. So I'm going to ask, what is it that in any deal, what is it that you bring to the deal as a person? What are your strengths and what are your weaknesses as a property investor, property developer?
Yeah, no,
that sounds like an interview question for a job. That
Hire me, I'll send you my CV. When I said 500 a day, I actually meant 1,000 a day. Yeah, no, I think that I'll start on my weakness first. I think that I'm a very big picture thinker. So, and again, I think that entrepreneurs, property people are entrepreneurs, whether they want to take that label or not, we are, but we're also speculators. And speculators are exuberant and exciting, and they come up with new ideas all the time. So I come up with new ideas constantly and new strategies and just ways to take things. I'm very good at getting it from idea to first steps. I'm useless then at following through the rest of the steps.
Yeah.
And what I then try and do is get someone who's equally as enthusiastic to take it on and run with it. But usually it just doesn't happen. So that's my biggest weakness. And I think that's in property as well. I'm very good at finding the property, negotiating, securing the property, getting all the right people in place in order to grow that and take that forward. But the day-to-day just bores me, I'll be honest. And so that is my biggest weakness, because as a developer, the day-to-day is what really matters. And so I think that's probably where I came crumbling down, is because I thought that I had the right people in place. It's kind of like a conductor of an orchestra. That conductor doesn't know how to play the oboe or the clarinet or the violin, the flute, but they know how to bring it all together and make it sound wonderful. And I think that's my skill, is bringing people together. But then when you find that your flautist is not there and you have to step into that role, that's where I fall down. So as far as my strengths, yes, I think putting things together, finding great projects, because I was buying so much in Hackney, people just come to me, and even now they come to me with great deals and say, look, we've got this, it's off market, do you want it, first dibs. And that's really good to be known within an area, and anyone who works solely within one area will get that. And that's why I do say to people, just specialize in an area. It really is the best way of driving your property portfolio forward. One of the other things, is design. I love design. I love the way that design makes people feel and the emotions that it raises in them. So I love that. I also love the sales process, the staging, the selling, the negotiation, the psychology that goes along with that. So I think that's probably what I bring to the table. And then also I had money to invest, and that's always useful.
Always good. Always good.
So she got the job then, Rob?
Yeah. You know what? She can have my job.
I love podcasting too. I love it.
Well, I was going to say, so if we look to the future, obviously we touched on the word Brexit, and obviously the COVID pandemic going on at the moment. Obviously Brexit's coming closer. Was it the new year? Pretty much, it's going to apparently come into force. So what are you doing to sort of preempt that, work towards that? What are your thoughts on it, and how are you looking at it?
Yeah, I'm worried. I'm very, very worried for next year. And I don't want to scaremonger, and I hate being so negative. I've decided that I've been so negative on my Instagram over the last few months. I just want to be positive from 2021. But it's still, I think we need to be realistic as well. So what we're faced with is the uncertainty of Brexit, and we don't really know what's going to happen there. We're faced with the fallout from the economic support packages that have been provided by the government, which have been very, very welcomed. We've got unemployment that's going to increase with all the furloughed staff that if they've already been laid off or if they're about to be laid off. We also have a really interesting statistic that I heard yesterday, is that retail landlords have only been able to recover 13% of their annual rents for the year. So 13% for the whole year is all they've been able to recover. So I think that we're about to go into something that is not going to be pretty. So I'm concerned about that, but also I'm excited about that. I'm concerned because I want to make sure that my house is in order. I want to make sure that I've secured the lending on all the properties, that I don't have any refinancings coming up in the next 12 months. I want to make sure that they're all on buy-to-let mortgages rather than development mortgages. So I'm working really hard right now to get those on. It's hard. It's really, really hard because of the loan to values, which have dropped. Oh, sorry, they've increased. The values have dropped, the loan to values have increased. That's really difficult. So that's really what I'm doing right now, and what I will be doing into the new year. And that's my sole focus right now, is just really securing that. To use a sailing term, it's battening down the hatches, isn't it? And just ensuring you can see the storm coming, you just get everything ready and you ride out that storm the best you can. But it's exciting because you think about the people who got into property like I did around, and I think you guys are probably too young for yours, much more recent, but anyone who got into property around 2008 onwards, or 2009 onwards, really had a great time of it. And I'm looking forward to once again participating in a strong upward growing market. And that's why I just want to have I want to have cash available so that I can do that, or at least assets that I can borrow against that are secured assets. So that's exciting. I don't know how long that's going to be though. That could be in a couple of years. You think it took a couple of years to recover from the world financial crisis. So this could take a couple of years as well. I think that the tax changes are going to be with us for a long time. Higher rate income tax payers are going to obviously always support this. And so there's a few other things as well that are going on. Local authorities are discouraging smaller developers. Governments are discouraging smaller property landlords. So there's a lot of other little things going on as well, but I just think that there are always going to be opportunities there. It's just being in the right place.
It is odd, isn't it? It's odd that we all sort of can see something bad happening, and obviously from COVID from the beginning, we all knew that there was going to be a big economic fallout, but we haven't experienced it yet. And it's almost like every month we just think, is it going to start? Is it going to start? And you start seeing like the likes of Arcadia going into administration. It's the beginning of the big mass redundancies. We saw some with the airlines, but obviously they're picking up a little bit now. But it is weird seeing the storm coming, well, because with 2008, unless you was in the inner circle, we were all completely oblivious. So everyone thought that the sun was going to shine forever, and then all of a sudden it come to a crash, like when Lehman Brothers went under instantly. But this isn't an instant Lehman Brothers. This is we've all been watching it. It's like any minute.
Yeah, absolutely.
I guess to use like a banking analogy or a stockbroker's analogy, this is kind of the property version of a tree shape over the next, say, year or two, where, like you said, have you battened down the hatches? Is your house in order? Are your loan to value steady? Can you ride out this storm? And you said, people who bought in 2009 onwards have kind of ridden this storm up. 2009 is when I bought my first property. So I've been really, really fortunate that for the last 10 years, I've had great growth where I am. I wouldn't say it's been easy. There's been challenges along the way, but I haven't had to go through something like this. Yeah. So these people that are fresh in property 1, 2 years, 5 years, haven't had to go through what could be coming. And it's going to be interesting for me to experience that first, as you said, cycle, the bad part of the cycle. Can I get through it? And one of the things you said, which is really important for those listening, is you're talking about getting off a development and bridging finance and securing your buy-to-lets, right? So one example I give when I'm talking to people is, well, if you buy something for 100,000 and it makes you a net monthly cash flow of 500 quid, great. If it then drops in value and it's now only worth 50,000, but it still makes you 500 net cash flow, there's no loss there unless you sell the damn thing. That's when you just don't sell, right? But where you can get caught out is if you buy something for 100,000 on bridging or development finance, and before you've switched it over to a buy to let, it drops to 50%. That's where you're going to get yourself in trouble, because you haven't got the margin, the equity, the loan to value space there to get off of that bridging finance. So that's what I've been doing for the past 6 months. I had a few projects myself that were on bridging, and I've been like, that is priority number one, has been getting off bridging as soon as possible, no matter what. Just get off the bridging. Once it's on the buy to let, I don't care if the values go down, because they're rented and it's fine. So for those of you listening, that's really, really important. And I think anyone that's experienced in either development or bridging is going to know that, but maybe people who are using it for the first, second, third time might not kind of put that together. You also said about Hackney and you're still getting offered deals, right? And I like that, because that shows you've built a relationship with those people in that area. Yeah. So it's not like you've bought one or two. I'm sure that you probably worked on those relationships with agents and local people. So can you tell us a bit more about that? Are you still doing those deals? Are you passing them on? Are you just saying, I'm not really doing that anymore? Where are you at with those?
Yeah, so I think that it's really important to establish relationships. And this is when people say, I live in London, I'm thinking about investing up north. I go, well, there's nothing better than the area the area you drive around, you walk around. Just for establishing those relationships. And people often scoff at this, but I developed a really good relationship with Foxtons in Hackney. And it got to the point where things wouldn't even hit the market. They'd just come straight to me and they'd say, yeah, look, this is really good. If we put it on the market, we think we'd get a bit more, but they don't want it on the market. They just want to sell it. So it's yours. And I'd go, okay, do my appraisal, and I'd buy it. And because I performed, they would just bring me things. And or I'd get inside information. We've just had the highest offer, might be in the region of this. If you go to this, it might be yours. And
so that's the power of relationships, right? That's the power of
absolutely.
relationships. Yeah,
and
they know they want you to buy it. They know that you will perform. They know you'll do what you say you're going to do. And I'm sure they knew that once you'd refurb the property and put it back on the market for sale, it was going to come back to them to do that as well.
It always came back to them, exactly. And even now, that's the same. And I think that people are often quite down on estate agents, and they have in the past had a bad reputation. And yet, very rarely did I experience that. I had one land guy that once I did an appraisal of a property, and I think I came at around 4.5 million for this particular property, and his highest offer was 7 million. Wow. I'd just like to say that it went into administration a few months ago, actually, that particular project, because they did just overpay for it. But my appraisal said 4.5 million, and I wasn't budging from that. And the agent said to me, go back to playing with the doll's house and let the men play with property.
You're joking.
And that's really the only time I've just thought, this guy's an absolute.
Were you established at that? Were you established at that point? Were you very well known? Had you done a lot of products? Where were you when that happened? When you were
this was 2017, so I'd done a lot, and I'd published my book, and I'd done things. So it was really just
what is wrong with people? There's just people out there, and you're just like, just grow up. What is wrong with you?
Oh, it's interesting. Actually, I never really experienced any sort of sexism in property. Being a woman, and it's always served me well, because I do stand out. Not so much now, because there are a lot more women in property, which I think is great. But what does still happen, and it only just happened about a month or so ago, is that I'll be on an email, CC'd on this whole big email, and it'll be going backwards and forwards between monitoring surveyors and engineers and architects and things. And then they'll reply to everyone, and then they'll put me in the two and say, dear Nicole, would you please mind sorting out payment? So they think I'm the admin. And I'll just reply, copying everyone, going, I'll ensure that the office looks after this.
By the way, I'm the boss.
Developer.
So how did you deal with that? It was the agent, was it, that said, go back to playing with the doll's house?
Yeah, I think I just told everyone.
That's a great way of doing it. Is just embarrass them
that's
straight
right.
back.
Name and shame, and I think that's all I did, is just say, look, and I'd never deal with him again. But that's one isolated issue, and I think he was of a certain age and probably of a certain. And I don't want to generalize, but he was just a certain sort of person that was very chauvinistic.
You can imagine. You can see the type.
Yeah, exactly.
So the question is, you stuck to your numbers, you walked away from it because you knew it wasn't right. You've been proved right because it was overpaid for. They've now gone under. Yeah. Is there a chance for you to go back and now pick that up as a deal?
No, unfortunately, it went before I even knew, and I didn't even know that this was going under until it was too far, and I sort of not even looked. Honestly, I'm not even buying at the moment. I'm so busy just securing what I've got. But to answer your question, I could have. If my finger were on the pulse, I could have. And I think that answers your question before. Do you still get offered these deals, and what do you do with them? So I'm very careful with who I partner with, and there are not many people I trust anymore. I'm a little bit jaded, but just from recent experiences. But there is
property would do that to you. Property will do that to you.
My goodness,
So for you guys listening, you're going to come across like issues with joint venture partners, things going wrong, man. And eventually you're just going to kind of want to do it on your own.
Yeah, exactly. I think that's where I'm at. I'm either do it on my own completely, or with my partner, my life partner rather than business partner, or there is a family in Hackney who have been investing since the 16th century. They own hundreds of properties in Hackney, and they own tens of thousands across the UK as part of their family since they've been investing so long. And when they look at things, it's really, really interesting. And I think this is a good lesson for all of us, really. And this is why I say to you, we're here for the long term, and it's about building long term a legacy, really. When they look at things, and when you go on site tours with them, they'll say, oh yeah, that the lease for that is up in 80 years, and then at that point we'll do this and we'll do this and we'll incorporate it. And you just think, wow, 80 years, you're not even going to be alive then. And yet, because they've got this longevity within their portfolio, that's the way they think. And they'll say, yeah, in 20 years time, the covenant's going to expire on this, and we'll do this and this and this. And it's just fascinating. And because of this attitude, they don't have any reason to rip people off, because they've been doing this forever. Their reputation is incredibly important. They're not in it for the quick buck. They're in it for the long term. And so often, if I get sent anything, I'll just pick up the phone and go, hey, Charlie, this has just come across. And we work on it together. And we've worked on one recently. And unfortunately, it doesn't look like it's going ahead. But we spent hours of work on this really big development in Hackney. And so fingers crossed it goes ahead. But I can't wait to work with them more closely on a development. But something will come up.
I absolutely love what you just said, because most in property investors as such might think in the 6 month timeline, as in a quick flip, or the 2 to 3 years on refinancing or a little bit of capital growth. Most people don't really think past 10 years. This is like legacy level thinking.
But I think it's a snowball effect, though, isn't it? I think you need to start almost short term to get yourself to long term, because you can't buy something now and think 50 years for this one. If it's your first property and you're thinking the covenant's going to expire in 20 years, you're not going to get very far very quickly. But I think it's definitely a snowball effect. I think you gather that pace, I think, over time.
I like that they're thinking about the overall picture. So it's this family as such. It's not just what am I getting out of this?
Yeah.
It's what is the legacy out of this investment for the family for the next 3, 4, 5 generations.
Yeah, I love that. Just before we wrap up, Nicole, because I know we're pushing for time at the moment. You mentioned your book, so Bricking It. Can you tell us a little bit about your book?
Yeah, should I'll run and grab it?
Yeah.
You'll see my light ring secret now.
Yeah, it's all right. We're both exactly the same. I can see it bouncing off of Rob's glasses.
Okay. Oh yeah. I didn't even notice that. Here's my book.
Yay.
So I wrote it in 10 days over Christmas 2016-17. And the idea was that I was on the property circuit speaking all the time, and this lady just came up to me one day and said, why don't you write your book? It's really interesting. I'd never even thought about that. And then that was sort of in summer, and I basically plotted it out. And then because I had this amazing process, I wrote it in 10 days. And I just wanted to weave in my story and just talk about the different areas of property and how to find a strategy that suits your lifestyle and create an attractive brand so investors and partners come to you. Learn as you go, being prolific, not perfect. I've not read that before.
Did you not write that?
No, I didn't. I didn't write that.
How did you find the process of writing a book? Like the actual psychology of getting it out of your head and onto paper?
Do you know, I loved it. I loved the process. Well, actually, no, I loved the writing until it got time where you had to do all the proofreading. And that's when I just went, talking about what we're talking about before. I'm really good at the first stages, and then it's just someone else dealing with this. So I worked with Rethink Press, and they just deal with all that stuff for you, so you don't have to worry about it. But I loved it. I really, really loved it. And I've never had a wedding, and I've never had a big birthday party or anything like that. But my book launch was amazing, and I loved it. And I just had such a wonderful time having the people that were close to me in London and some further afield that came to support me and celebrate the book. I actually, and this is quite interesting, I think that it's really important to have goals in place that you wish to achieve, because I'd achieved this book by the October of 2017, and I got to October, the book launch happened, it went to #1 on Amazon. I had guys yelling out of white vans going, "Nicole Bremner, I saw you in the Daily Mail this morning." So I got my 5 minutes of fame, which was really funny, but and then I had nothing, and it was really weird. I had this real emptiness, and I think that for a good couple of years I just drifted because I didn't have any goals. I'd written my book. I've written 2 other books, but I'm not happy with them. One because Gary Vaynerchuk went and published the exact same book just as I finished mine. So thanks, Gary. It was kind of a summary of all the social media platforms and how to use them, and he then went and did his. So anyway, I'm going to change that around just so it's very property specific and release that anyway because it's written. And I'm now writing another book called How to Lose Millions in Property, which is why I'm reading this one. What I learned losing $1 million, because it's quite relevant, even though that one's about trading. So I am writing that because I think there are too many people out there that are peddling a dream of get rich quick and do this really quickly, use other people's money. And it's not like that. And so many people get caught up with dodgy mentors and dodgy education that's not worth the money they pay for it. And I just want to give a really, probably a bit too negative, I know, but a really realistic view of what property is and how it is for the long term, and how you have to just be incredibly prudent. And it's like, Rob, what you were saying, just really secure your portfolio and be in there for the long term. It really is a long-term investment. So yeah, that's my next book that we're writing. And today I'm launching a special book writing course, actually, or not a course, sorry, it's just a book writing accountability group where people can come and all write their books together and be held accountable for each other. So I'm looking forward to today.
Cool. Oh, brilliant. So how do people get in touch with you if they want to follow your story and follow yourself?
Everywhere. I'm on all social media platforms, so they can just look me up there, or my website, nicolebremner.com.
Fantastic. No, I really enjoyed that, Nicole. Thank you so much. Or sorry, Rob.
I was going to say, your book, is it on Audible as well, or is it just a paper copy?
It's on Audible. I read it on Audible, so you get to hear my Aussie English sort of mixed twang reading that. My partner said it's not my best work. Do you know, your podcast sounds great. That's another thing. My Nicole Bremner podcast, which is my favorite thing in the world to do. So that's another place that people can find me. So, but yeah, it's on Audible, and you can also read it. And I'm also happy to sign a copy if anyone wants.
No, thank you so much, Nicole. I really enjoyed that this morning. That was really, really interesting.
Thank you. Really, really
I enjoyed it too. Thank you.
Great insight.
Thank you for listening to the Property Investors Podcast. The information contained in the podcast is not to be used as financial advice. Everybody's situations and goals are different, and you should always complete your own due diligence on investments and seek personalised financial advice from a qualified person. Feel free to contact the show for professional recommendations. Visit propertyinvestorspodcast.com.